So our next one is going to be from Lennix Lai of OKEx. He's Director of Financial Markets at OKEx, and he's going to talk about NextGen crypto derivatives. Hey, welcome, Lennix. How are you?
Sure. Yeah, well, it's a pretty late in Hong Kong time.
Okay, cool. Yeah, it's pretty late for you. All right, well, you have the floor. Go right ahead and give your talk.
Thank you. Thank you.
Thank you.
Let me share the screen of everything first. Yeah, thank you for George and Bitcoin Cash inviting me to talk about NextGen of crypto derivatives. So my name's Lennix. I'm the financial market director of OKEx. I've been OKEx for 3 years since the very beginning of the creation of OKEx. So remember the last speaker that's talking about entrepreneurships and innovations. I think that's actually a little bit a good story to share with you guys, that how we as a crypto exchange that would like to create the very first crypto derivatives ever existed in the world before that the demand is actually created. Because back in like 2017, 2016, nobody knows about the beauty of derivatives. We are basically talking about might be spot market. We would like to buy Bitcoin. We worry about how to buy Bitcoin. We worry about how to get into Bitcoin as soon as possible. We would like to buy Ethereum, Litecoin as soon as possible in a regulated manner with your fiat currency. But so that the demand back in the time, I'm mostly talking about how to open an account in exchange as soon as possible, how to buy Bitcoin and to do with certain bank accounts, what's the fees involved. But nobody is actually talking about derivatives. So it's like an absence of demands over there. So as a startup or as a company, you somehow, it's very difficult to create a product when you already recognize a solid demand. You have to somehow foresee the demand is going to be there, and you prepare for it, and you create for it. So luckily, in traditional finance, we have a lot of experience from traditional finance in stock market and equity markets, that eventually, whatever asset class that you're trading, you eventually need derivatives or certain kind of derivatives, especially for you to assist on the price discovery process. So that's why we do a little bit of research, and we think that would be a solid demand. And so that's why we create the very first derivatives ever exist in the world. So we create the very first futures, cash settled futures, serving for miners to hedge the exposure whenever they mine a Bitcoin. Because back in the time, I think we talked about several years ago, Bitcoin is still super volatile compared with all the other asset class. So for all the miners, before they understand the concept of hedging, we know them, we understand them, they need certain other type of instruments to manage their cash flow, to manage their P&L, to manage the exposure. Whenever they mine a new Bitcoin, they really worry about Bitcoin will crash on Friday. We worry about the Bitcoin will be crashed 8% on one day, so that they have no way to pay off their bills, electricity bills and human bills. So that's why. So I would like to say it's like the story of creation, the story of innovation of OKEx derivatives, most likely of recognizing the demand beforehand with leveraging experience from the other industry. So far this year, we spend a lot of time and we spend a lot of efforts in creating different kind of derivative products, and we believe that derivative products is one way to tackle the volatility of the crypto asset, the cryptocurrency, and that is actually is happening. So right now we are having multiple derivatives currently trading the world futures, perpetual swap, and option and spot markets, and it within the margin with multiple venue, with multiple exchange right now. So right now we can see the result like from the peak volatility of Bitcoin, talking about 200% or 250% annualized returns, annualized volatility. Right now, I think it's substantially decreased it to around 8%, even 30% in price volatility right now in Bitcoin or the other crypto assets. So people want that to talking about to solving the volatility of crypto asset because it's so volatile, because Bitcoin can never be the cash because it's so volatile. I think with proper instrument, with proper market structure, with proper derivative contract, the problem will be eventually solved. So we can see the trend we're heading to a really, really positive direction with the industrial joint efforts of as well as the participation and contribution of derivatives. So I think right now derivatives is talking about accounting for at least 2/3 of global trading volume of cryptocurrency. So right now, as alone in the OKEx, we are right now having futures and swap trading together around 2 billion or 4 billion per day, notional USD per day. And we recently launched option for traders to price, to hedge, and even to trade volatility directly. That's distributed option. So I think the space of derivative is unlisted derivative at least is already quite there. It's already quite liquid. It's already quite robust. So exchange already spent a lot of efforts into improving. Later we'll talk about a little bit more how we improve the futures, but improving the future risk management mechanism as well as the matching engine, as well as the robustness of the system that caters specifically for derivatives trading. So before we create that, we actually recognize that derivatives is actually a highly leveraged instrument, and with that, it's actually very difficult to as a cryptocurrency exchange to manage the risk, and also derivatives, because of its highly leveraged nature and its professional nature, tends to be clients or users tend to be requesting a really low latency of infrastructure for them to execute their trade, and for us, for the platform to liquidate position as well to risk management. So also it's a challenge. Creating is a challenge of both, right? A robust risk management system and design, as well as a really robust trading architectures. So luckily, I think OKEx and all the other mixture exchange had really done a remarkable job into improving overall structures so that trading on derivatives right now, if we compare 2 or 3 years right now, is considered a lot safer, a lot more easy, and a lot more fair in compare 2 or 3 years ago. So right now you can see, because of the continuing commitment of the product innovations and the futures market as well as all the derivatives market in the world right now is actually crying so fast since the beginning of 2017. That's part of the reason I think because a big commitment of all the crypto exchanges, or some of the top-notch crypto exchanges on derivatives, as well as the creation of CME Bitcoin futures that's available for traditional traders to actually have exposure on Bitcoin directly in a regulated manner. So everything in a combination that shoot up the entire derivative space in 2 or 3 years. Right now we're trading a few billion per month, and I think right now we account for around 152% of all the other major competitors in the world, and also most of the volume are concentrated still on Bitcoin or Ethereum or Bitcoin Cash or even of Litecoin, for example. So most of the volume, I think, right now is concentrated on futures and as well as perpetual swap. So right now, a proportion between the future and swap right now is around half already. So perpetual swap is actually growing so fast compared with the other futures exchange. So that's already two types of Delta One. I would say the Delta One derivative instrument that's actually trading available in the markets right now. So a majority traders will be picking on perpetual swap because of its synthetic natures of a margin instrument, so that the price of the swap itself is actually trading very similarly with the spot markets. But the problem of swap is actually having a consistent funding rate or the inconsistency of the funding rate, so that holding positions of the perpetual swap might need to consider a cost if you would like to hold a position for a very long time. But in contrary, futures doesn't really have a problem. So future doesn't really have a cost of carry, doesn't really have a cost of holding position of all the future positions. So most of the users right now are actually utilizing futures as majority of hedging tools, so that they will carry a spot position and hedge on the futures side, because they don't need to worry about the cost of holding position. They just wait for this settle. So on the contrary, maybe swap is most likely a leverage instrument or synthetic margin instrument, some an instruments that trade similar with spot. You don't need to worry about the basis, which is defined as the differences between spot and the futures price. You don't need to worry about the basis on swap. So it's trade like spot market with leverage instruments without the buying or borrowing lending instruments. So it's really convenient tools for speculative traders. So right now it's interestingly enough. So swap markets and the futures markets actually trading in terms of very similar volume, at least on similar liquidity, similar bid-ask spread, and similar different kind of market behavior as well. Of course, there's a lot more variety of different kind of strategies can be implemented on both futures and swap, but actually the two markets right now is actually behave very similar, and that's very interesting to and a very good reference point to. We don't see that often in traditional market. In traditional markets, mostly a futures market. We don't have a liquid listed swap markets trading in the order book style. So right now OKEx already kind of like climbed to really top notch in terms of spread liquidity ever existed in the crypto market, and the market is still growing due to the fact that we spend really a lot of efforts into optimizing our latency and optimizing our TPS per second. So right now, I think OKEx, if you talk about round trip time, round trip time per orders for all the market, including spot, futures, and swap and option, I think it's closing around 10 or 15 milliseconds per round trip. So talking about when sending orders to matching engine, receive an acknowledgement, and comparatively, if you talk about comparatively, like 2 or 3 years ago, I think the latency is talking about maybe 100 or at least 200 milliseconds per round trip. So it's a substantial improvement due to the fact that of these kind of substantial improvement on the trading architecture, traders can trade even more. And an exchange can actually accept a large amount of orders. So that's why the volume still climbing across the entire crypto derivative space. So the next topic, I would like to highlight a little bit about the conundrum of the risk management of creating a really high leverage instruments on crypto derivatives. So all the creators of that running a cryptocurrency exchange, you have to face a conundrum, a trade-off between liquidations, whether you would like to adopt an aggressive style or passive style of liquidation, how you want to liquidate your orders, your client's order whenever it touch the bankruptcy points, and also how you would like to charge the maintenance margin, meaning that's how much money that you allow your traders to keep at a bare minimum before you execute your liquidation. There's always need to be a trade-off, right? Because every traders want to keep want you an exchange to charge as low as your maintenance margin as possible, because the effective leverage it will be essentially higher. But at the same time, if we keep maintenance margin low, or so we have to the exchange will be exposed if the exchange cannot liquidate their orders as soon as possible under a certain time of margin. The exchange will face some problem like you need to add into your insurance fund, or the exchange have to pay off by themselves. It's very bad for the business and the individual or the traders eventually. So it's a balance between how much we need to charge to the client as a maintenance margin. At the same time, we have to consider how robust, how fast, of how we handle the liquidated orders. Whether we would like to aggressively liquidate the orders or passively to liquidate orders as soon as possible. So also we need to explain a little bit about funding. Funding is more like a way for a very unique style for the clients to hold a position on the perpetual swap. So funding is actually a mechanism for a swap instrument in terms of price to have a certain mechanism to anchor back the price on the spot market. So when the swap price actually substantially deviate with the fair value, which is the spot in this market, some of them need to pay something. So if the swap market is actually trading a big premium against the spot index, we would need to the funding rates would actually dictate that whoever holding a long position have to pay some kind of interest to the short position. So, but at a particular point of time, the short position holder will be incentivized to open a lot more short position. So because of that, there will be a short more position. The price eventually of the perpetual swap will be anchored back to the spot index. So it's a mechanism that naturally or dynamically to somehow bring back the perpetual swap price back to the fair value. We occur around 8 to 12 hours right now. So it's a completely market-driven mechanism. So I would like to talk about the TM margin. That's a really kind of like an innovation of the OKEx as well, about how we handling maintenance margin and also how we liquidate the orders. So essentially, back in time, I discussed a little bit about if we really want to maintain a relatively low maintenance margins for all the traders, and at the same time, we would like to manage our risk, the risk of exchange as well. So what we're going to do is, hey, maybe we don't need to liquidate a big chunk of orders all at every single time, right? So what we're going to do is basically, whenever the traders are exposing to encounter liquidation, we will not liquidate every single amount of a position. We will just basically liquidate percentage of the liquidation of the position first. After we liquidate a certain percentage, we will take a look, hey, what is the latest margin percentage right now? If that is the case, if after liquidation, if your buying power back to normal, we will stop our liquidation. So the trader can retrade, can reuse the margin again, and trade again. So the benefit of this is we don't need to liquidate lost position all the time. We just basically liquidate a percentage of liquidation. It's the easiest for us to handle, and also the trader will like it because they understand that as long as they don't, if they're facing liquidation, they don't need to face a total loss of the entire portion of liquidation. It's basically a percentage of the liquidation or liquidated orders will be affected. All the rest will remain to normal. And due to the fact that we allow our margin would be charged on a tiered basis, so that's why we can allow our trader to adjust margin in real time or any other time because of that. So whenever we talk about right now in cryptocurrency markets, you're allowed to trade around 100x market, at least 100x leverage. But in reality, you can actually adjust all kind of leverage at any time. So from zero leverage or even one leverage to even 100 times leverage. So to summary, I think right now on OKEx perspective, we do have a different kind of maturity derivatives market in the world right now. So for example, like we do have a perpetual swap market that actually reflecting the basis in interest rate for 24 hours. And also we got a weekly, bi-weekly, quarterly, and bi-quarterly futures. So on OKEx alone, you can actually map out the yield curve from 1 day to 6 months, according to our for all the maturity of the derivatives markets. So I think maybe time is up for today. I would like to thank you so much. I would like to take some questions.
All right, excellent. Thank you, Lennix. We have a question in the chat. Can you explain in layman's terms what are derivatives and what are the benefits?
Yes. So derivatives, by all means, is just an agreement. I would say an agreement or a contract in which the price is derived by something else. For example, you can create an apple, right? The price of the apple you're trading, this the price of the apple is $10. I can use $10 to buy an apple. But at the same time, I can also create an agreement reflecting 100% with the price of the apple. So why people do something like that? Because one of the very distinct derivative contract, especially in futures, is we got expiry date. So we're talking about like this kind of agreement is reflecting completely on the price of the April price on futures. For example, like Friday. I understand as a buyer, I understand I want to buy 10 a big barrel of apples on Friday, but I don't need that right now. I don't need that right now. I need that on Friday. But at the same time, I'm so afraid that on Friday, the apple price will shoot up like 10 times more. I don't want to expose the risk. I understand that on Friday I need a big box of apples, but I don't want the price on Friday will shoot up like 10 times. So what I'm going to do is sign an agreement. The agreement basically tell me that, hey, no matter whatever price on Friday of that particular apples, you are going to buy, absolutely sure that you're going to buy that apples on Friday at $10. So that agreement, we call it as a derivative contract, because representing the price of the apples, of big bucks of apple on Friday.
All right, excellent. Okay, well, it looks like there aren't any other questions. So thank you so much, Lennix. Really glad to have you with us today. And thanks for this, interesting presentation.
Thank you. Thank you.
Okay.